Palisade Radio is brought to you by First Majestic Silver Corp, one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning guest to the program this week is Jordan Roy-Byrne. He's the publisher of thedailygold.com. Jordan, welcome back to the program.
Colin, thanks so much for having me.
I think we had a bit of a whipsaw week in gold. I woke up Thursday morning, lots of excitement. Gold had finally broken above $1,300 an ounce. Then later in the day, dropped by about $30 down to $1,280. A lot of fear kind of started that a pullback might be coming. And then today, Friday, June 17th, we ended with another good day. Jordan, is this the type of action that investors in the gold space should get used to? Any explanation as to why?
Well, Colin, as far as getting used to this type of action, not necessarily. I think the reason why we're seeing this action is a number of factors. Looking at gold itself, there's major resistance at 1,300, and the bulls are trying to push gold over that. The bears are trying to defend that. I think a lot of people have talked about the COT and the buildup of speculative positions, and that's why gold is having trouble breaking above 1,300 or at least sustaining that break that it had yesterday. And obviously you have what's going on with the Fed and Brexit on top of that coming up next week. So there's a lot of factors here that I think are causing, as you said, the volatility and the whipsaws. Now, in the larger picture, just stepping back, the stocks have been on fire. They've done really well. They haven't corrected that much at any point. I think in the big picture, that strength is going to continue. However, looking at just the last week or so, the stocks have kind of been, I shouldn't say kind of, but they have been underperforming gold, and usually that's a short-term negative sign. Now, late last week, the stocks and the large caps, GDX specifically, ran up and touched their 2014 resistance. So if you're looking at a 3 or 4 year chart, that's a key resistance. It's obvious if you're looking at the chart. That comes at about 27 for GDX. And so the fact that, and in addition to that, in the last couple of weeks, the gold stocks from their recent low, GDX was up 20%, GDXJ was up 25%. Again, that was all in a 2-week period. So we have the stocks approaching some key resistance. They're really overbought. Now they're starting to underperform gold just a little bit. And so that tells me that we're not going to see a huge breakout move in the short term. And in addition to that, I mean, as I noted, I mean, you have the Fed, and people always react to that one way or another. Then you have Brexit coming up. So there's a lot of things going on that are really influencing the market as far as day to day. But in the bigger picture, as far as the very short term, I'm still a little bit cautious. I think the stocks are going to consolidate here in the weeks ahead. And with gold, I'm a little skeptical that we're going to break above 1,300 and run. But I'm not selling anything, Colin. I'm not getting bearish because I do think eventually we're going to continue to move higher. I'm just a little skeptical that it's going to happen here immediately.
As you said, no major corrections yet in this bull market for the stocks, and maybe no major corrections in sight. And that's the story of bull markets that follow epic bear markets, something that you told me about before we got on the interview here. No major retracements or corrections until maybe 1 year after the recovery begins, which would put us at maybe January of 2017. You've seen this in history. A couple examples, the tech stocks after the 2000-2001 crash. You had a very strong recovery with no pullback. The stock market we've seen after the 2008 crash. Jordan, talk to us a little bit about why this could be different this time. This could be a much more strong, powerful, no correction type of move out of the bottom.
Well, the reason for that, Colin, is what we're seeing in the gold stocks. It's very similar to what we saw in the examples you gave, where there's been points where the stock market had a real epic bear market, and you noted the examples. I mean, in particular, the tech stocks, they were down 78% from 2000 to 2002, and then they recovered after the bottom. They went up 94% in 15 months. Now there was a 17% correction there at the beginning, but the stocks were still kind of bottoming. It wasn't obvious to people that they had bottomed. I mean, they had a huge V rebound and then they came back down. And we kind of saw that similarly in 2008 in the gold stocks. After that October bottom, they had a big move up, and then in November they kind of made a lower high. It wasn't quite a double bottom, it was more of a lower high. But after that point in the gold stocks, they didn't really correct more than 20% following that bottom. I mean, they increased steadily really for the next couple of years until they peaked. Now, going back to the NASDAQ, again, 94% recovery in 15 months. And after that 17% decline, the worst declines it had were 8% and 7%. And as you noted, another example of that was the epic bear market we had during the financial crisis. Again, the low in 2009. The S&P 500 from 2009, March 2009, over the next 13 months was up 83%. And the worst corrections were 7% and 9%. And looking at the NASDAQ, which is a little bit more volatile, it was up 100% in 13 months. Its worst correction was 10%. So, and just one more example, 1942, the S&P 500 after the 1942 bottom was up 70% in 14 months. So it didn't rise as much as those other examples, but 70% in 14 months is still very significant, very strong. But interestingly, Colin, during that 14-month period, the S&P didn't even correct more than 5%. It actually didn't correct more than 4%, other than 1 point late in that 14-month period, it corrected 5%. So now the point of all this is, those examples I gave, those were rebounds that followed really nasty, really bad bear markets. And now this doesn't mean that every time you get a really bad or nasty long bear market that you're going to have this V bottom for the first year. But I mean, these are some clear examples, and we're seeing the same thing playing out in gold stocks, where they really just got out of the worst bear market ever. And again, they've had a huge rebound over the last 5 months. They haven't even had a 20% pullback yet. I think it's 17% or 18%, the one recently, up until that really negative employment report we had a couple weeks ago. But the gold stocks, they're following the pattern that we've seen in these other markets. And so even though the gold stocks are just, they're a tiny sector, they're really their own animal compared to the broad stock market, but markets have similarities. And again, it's very similar. It was a really bad bear market. It was a really long bear market. And what's happening so far is we've had a really strong rebound for 5 months without a 20% correction. Again, we had 17 or 18% recently. And, in comparing that to the stock market, a 20% correction in gold stocks is probably equivalent to 10% in the stock market. And what these examples argue for moving ahead is that gold stocks really could really could continue to rise and have steady gains over the next 6, 7, 8 months before they have some big retracement. And so what are potential upside targets for the next 6 months? Looking at gold, I mean, it obviously has resistance here at 1,300, then a little bit at 1,400, but the next big resistance is 1,500 to 1,550. And looking at the gold stocks, I'll just look at the Huey Gold Bugs Index, which I believe closed at about 227 today. The real strong upside target that would coincide with that 1,500 for gold is about 360 for the Huey. So those are the levels I think we could get to over the next 6, 7, 8 months or so, and then possibly that's the point when we see the first big retracement or counter trend move.
Jordan, gold's often cited as a leading indicator of inflation, and if gold's beginning to move, it often indicates that 6 to 12 months out, you'll see a substantial rise in the inflation rate. A substantial rise in inflation would theoretically be very, very good for gold. Looking at all of the things going on right now, do you see inflation picking up? If so, will that have very strong implications for the gold price next year?
That's a good question, Colin, because if we do fall into a recession next year, then possibly that's what could cause if we fall into a recession and then inflation comes down, that could possibly coincide with that retracement that I talked about. But obviously, we're looking ahead here. No one can predict the future. That's just an ongoing thought that I have that if gold goes to 1500, 1550, maybe a recession causes it to have its first big correction or counter trend move. But what I do think is is likely is that coming out of the next recession, which I don't think it's going to be like a crash like everybody's talking about. I mean, it doesn't happen after you have a really, really bad recession. You don't have another really, really bad recession. That it just doesn't really work that way. I mean, go back to Japan after the big recession they had in the early 90s. I mean, they haven't really they did after that. I mean, they just were mired in slow growth and then mild recessions, and that's kind of where we've been, where I think we're going for a little while. But back to what I do think is likely. Clearly, the Fed is impotent right now. They can't do anything that's going to help the economy. We've seen that, and it's got to come from increased government spending. Now, in terms of philosophy and principle, I'm against that. But if you look at a couple things, bond yields look like there's a risk that they could go down a lot more. They're already very low, so it's cheap for the government to borrow. Secondly, if you look at the deficit as a percent of GDP, since 2009, that's come down. I think it's come down from like 10% down to 3% of GDP. So given those things, there's a lot of room for the government to increase spending. And we know that if the economy goes into recession, or all of the people in the government think it's going into recession, they're all going to vote for more government spending. It just has to come to that point where they know, okay, we have to do this now. We're going into recession. They can fight it for the time being. But anyway, that's what I see happening. And if you look at both presidential candidates, I mean, they've both talked about it quite a bit. Trump a little bit more, but even I saw an interview with Hillary, and she was talking about that as far as economic policy. So I think we're going to see a huge amount of government spending, probably 2018. Maybe in 2017 they'll legislate that or vote on it. But I think that will really be the big driver for the next economic expansion, and I think that is when we're going to see inflation really pick up. And just a side note on that, if Trump gets elected, maybe the government will save money because he'll stiff the contractors like he's been doing in his private business life.
Well, Jordan, many factors that could be bullish for the yellow metal, like you've discussed: negative rates, inflation, potential recession led by government spending. You've even got the near-term Brexit vote, which could cause some movement in the gold price in the near term. All things seem to be pointing towards strong prices ahead for gold, which is a nice, refreshing place to be after the last few years. Despite that, Jordan's model portfolio up 300% in the last 7 years in gold. Miners still over that time period down by some 30%. So seeking professional help and subscribing to Jordan's work is something I do, and I suggest to all of our listeners. Jordan, if you have anything else to add at this point, go ahead.
No, Colin, thanks so much for having me on and promoting me. I really appreciate it. And yeah, I do think we could see a lot of volatility in the short term, but looking out 2, 3, 4, 5 months from now, I think we're going to continue to move higher in the precious metal sector. And there's really only two things you can do: hold what you have and then buy on weakness. And so if you're looking at stocks and you're waiting, I have a problem of doing this sometimes, where I'm waiting for it to correct 30% and maybe it only goes down 15% and I miss it. So take advantage of the volatility. If we get a 10 or 15% correction, or you see that in your favorite stocks, jump on that, because I think 2, 3, 4, 6 months down the line, you're going to be happy with that entry point.
All right. Well, Jordan, thanks so much for coming back on the program. Always a pleasure to have you on. Jordan Roy-Byrne, publisher of thedailygold.com. Jordan, have a great weekend.
You too, Colin. Thanks for having me.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?